Thank you for joining Westgate Global Logistics at our mid-year Logistics Insights webinar with industry expert Noël Perry. Today we're going to hear about trends affecting freight and logistics and gain insight on how the rest of 2019 and 2020 will shape up for all of us. During Noel's presentation, please feel free to submit your questions through the chat window. There's also a questions window on the webinar, and we will pass them on to Noël to address during the Q&A portion at the end. Westgate Global Logistics is hosting today's webinar. I'm here with Westgate's president, Mark Fiorini. Thank you so much for hosting this event.
You're welcome. We're pleased to host today.
Westgate wanted to host this event to help participants get the critical industry data, insights, and outlook they need. I'll pass it over to Mark now to kick off our webinar.
Thank you, Erica. For over 35 years, Westgate has maintained the reputation for delivering reliable freight solutions. In addition to servicing the standard methods of shipping, we also concentrate on meeting time-sensitive, unique, oversized, and specialty shipping needs. Through our large network of resources and our dedication to exceptional personal service, we offer a boutique approach to streamlining logistics. Our small, intimate structure also helps us remain flexible and capable of responding quickly with tailored solutions to satisfy the specific needs of each of our customers. We'd like to thank all attendees for participating in today's webinar. Through Noel's research and extensive knowledge on the freight industry, I'm positive that each of you will take some value from today's presentation, and we welcome you to challenge Noël with any questions or thoughts you would like him to discuss. Through Westgate's longtime involvement with and its support of the Transportation Intermediaries Association, we've had the pleasure of becoming familiar with Noël and his predictions. Every April, we attend the annual TIA conference, and in my opinion, Noel's economic outlook presentation is the highlight of the educational sessions. He has unique presentation skills and a passion for the industry that grabs the attention of the audience and keeps them on the edge of their seat. Recently, we've been fortunate to get even more exposure to Noël and his crystal ball, not only as Chief Economist for the TIA, but through his partnerships with truckstop.com and his Transport Futures newsletter, which we at Westgate read religiously every week. Noel's insights and predictions have been extremely beneficial to Westgate with regard to giving us a pulse on the future of the freight world, technology tools to consider, and what to prepare for in coming years. These are the reasons that Westgate wanted to offer this beneficial webinar today. So without further ado, I'd like to thank Noël for agreeing to join us today and allow him to begin his presentation. Noël.
Thank you, Mark. It's an honor to be here, and thank you, Erica, for helping set this up. I hope you can see my first slide, and I've chosen the title for a reason. It's the last cycle. And what I mean by that is that we are in the business cycle, the thing that goes up and down. We've had a big up a year ago, and I'm going to spend most of my time talking about what's going to happen next in this cycle. However, I want you to think about that word I used here, the last cycle, because by the time we get to this portion of the next cycle, the end of a long recovery, we're 10 years in now, the world that we live in transportation and logistics is going to change radically. And who knows what the cycle will look like that time. So what I mean to say is that for the next 4 or 5 years, we can fairly comfortably rely on what we've known about the past. This cycle is behaving just like the previous ones have, and I expect it to continue to do so through, let's say, 2023 or 2024. But after that, all bets are off. And so I'll spend a little time talking about that. It'll seem scary to you because it's such a big change. And big change means that if we don't change, we're going to end up doing something else. However, it's an opportunity. It's a change of tremendous opportunity. The world will be much better for it when we come out the other side. The issue is how we get through it. So with that, I'm going to start. Let's see if I can change these slides here. Let's see. Looks like I can. Okay, can I go to the next one? Let's see, is it over here? There we go. Okay, so the first thing I'm going to talk about is the history of the business cycle that we're in. And here's a picture, a scraggly picture, which shows three things. If you look at the blue line, that's GDP. It kind of jumps around close to zero. 3% is a pretty good year. Minus 1% is a pretty bad year. And then the red is truckloads, and that means truckloads go up and down a little bit more than GDP does. And finally, prices, and this happens to be spot prices, go up and down a lot. Now, what I want you to think about is two things in this chart. First of them is that all three of those things move together somewhat. Trucking is such a ubiquitous part of our economy that when the economy goes down, so do we. And when the economy goes up, we do too. And so, and we do so in this business at a multiplier. So take a look there at that of the statistics, right smack in the middle where it shows how GDP dropped to minus something in 2008. Freight dropped more than twice as much, and prices even more. At one point in that year, they were down 30% in the spot market. So there's also a multiplier, and what this means is when the economy moves, it's very important to us. It's not just the shrinking from 3% to zero or minus 1%. It's this shrinking from 6 or 7% growth to minus 10%. So it's really important for us to follow this cycle. And the last point I'm going to make on this slide is conditions go up and they go down, and they don't stay up and they don't stay down. And that's really important to us right now because last year they were way up for us. And a lot of people got a little lazy in thinking and said, well, it's going to stay up forever. Well, it's not. And we already know in the spot market that things are down quite a bit. Let's go to the next slide. Here we go. That was some statistics on growth in price and volume. The same cycles affect capacity. That's why prices go up and down. And here is my particular measurement of capacity. And you can see that it went up in 2004 when we had that hours of service issue. It went way down in 2008. Went back up again in 2014 when we had another hours of service and we had the bad winter. Slumped a little bit and then went back up again last year. You can also see that green line that jumps around a bit more. It's the seasonal spikes. So one of the things that we all know about intuitively is that right now, for instance, we're entering the hottest part of the season in trucking. Well, if you look at my stuff, you'll see it quantified, and you can see that those spikes make it even worse when it's up at the top, and they make it sometimes even worse at the bottom because if you're in a recession and it's January, you're going to be cold in more ways than one. So let's go to the next slide. Now, how come forecasters are afraid to deal with that cyclicality? Most forecasters say the world's going to be the same the next year, and here's the reason. What I've done here is to put the change in GDP, this is annualized quarter-over-quarter GDP since the year 2000, into these 5 buckets. The left bucket is the one with little changes from quarter to quarter, 0.1% to 1.4%. And the right bucket is when GDP changes a lot. And I've made this absolute value. That means I've made the negatives positives so we can put it all on one chart. And what this says is very simply that 44% of the time, the economy changes only by a little on a quarter-by-quarter basis. So if we're talking about what's going to happen in the third quarter, most of the time it's going to be very close to what's happening in the second quarter, and the same with the first quarter. Only 4% of the time, so 4 times out of 100 quarters, once over the last 10 years, less than that, does the economy change by more than 5% on a quarter-by-quarter basis. So If you're thinking about your forecast accuracy, if you're a contrarian like I am, who worries about those things that they're right, you're going to be wrong a lot. It's like my dad, who used to forecast snow every night in the winter, and most of the nights he was wrong. Now, once in a while he was right, and if I had taken his advice that day and left extra time to get to school and put on my galoshes, his advice was really helpful. So understanding the extremes is tough. But what it says is that most forecasters take it safe, and they only forecast small changes. The thing that's perverse about that is they're doing so in part because their customers don't want to deal with a lot of change either. And they don't want to have to worry about what's going to happen in recession a year from now. If it's only a maybe, what they say to me is, hey, Noel, tell me what's going to happen. Well, if I really knew what was going to happen, you'd be worshiping me, not listening to my talk on this webinar. So what I try to do is tell people about what the possibilities are that might affect them. Now let's go to the next slide. And what I've done here is to take that same data, it's in the red, and I plotted within each one of those buckets from the previous slide, how important it is in terms of change in GDP. So what you can see is those things that are unusual over there on the right are the ones that are very important. They're the ones that are going to make you go bankrupt or make you get rich. And so it's really important to have some sense of what may happen if it's going to be important. A friend of mine once taught me that what you want to do is to focus on those things that are possible and important. And if they're very, very important, even if they're only slightly possible, you still got to worry about them. Put you out of business or make you a lot of money. So what I'm going to talk about in the next 10 minutes or so is some of the more extreme issues we could have the rest of the year and next year, because that's the stuff that you have to know about. Anybody can do what they did last month, next month. That's easy. The smart people are the ones who can do something different and are ready to do so if the environment requires it. So let's go to the next slide. Let's see if I can get it. Oh, here we go. Okay. Oh, let's see. Let's go. Okay, let's go to the next slide. Sorry about this. Okay. So let's talk about now wait a minute. Yeah, let's talk about the trucking cycle itself. I've given you some background. Now, first I'm going to need to know is where we are before we can think about where the future is. Peter Drucker taught us that, the great management thinker, quite a while ago. And what I've done here is to graph the average quarter-over-quarter growth for all the recoveries since I was born back in 1946. And you can see something that's stunning about this chart. First off, this is the slowest recovery since World War II. And furthermore, each year we've gotten closer to the present, recoveries have been slower. So this has something very, very powerful about expectations for the next 6 months or year. And that is, it's unlikely to be a lot stronger than 2.3%, by the way, which is what that average is. I'm sorry about the index on the left. So what this says to you is the safest thing is to figure that the economy is going to be growing relatively modestly over the next year and a half, because that's what's happened over the last 10 years. And furthermore, the tendency of the economy to generate modest growth rather than the kind of strong growth that my classmate Donald Trump likes to think about, the tendency in the economy is very strongly towards modest growth. Let's go to the next slide. So here is my outlook. It's a real simple outlook for 2019, and that is we're going to hit the average from the last 10 years. It might be a little bit stronger than that, might be a little bit less. And the things we see in the um, measurements that the federal government gives us right now are very mixed. They're a little bit more negative than they were a year ago, but they're not profoundly more negative. They certainly aren't strong enough to suggest that we're going to accelerate, that 3.1% growth we had in the first quarter is going to stay for the whole year. So my advice to you is be very prudent for the rest of the year and figure out that it's going to be somewhat like what we've had the last couple months. And I'll show you in a minute that those conditions in trucking haven't been very good if you're in the spot market. So let's go on. Okay, now we need also to look at what happened to the cycle in trucking specifically. And what we all know is that there was a capacity crisis a year ago. It was a driver shortage. And there's a lot of argument as to whether there really was a driver shortage or not. I would put it in two terms. First off, all the freight got moved. So if there really had been a driver shortage, some of that freight would still be sitting on the dock. Well, it got moved. Now, we also know some of it got moved a little late, and you guys had to work a lot harder to find the capacity to keep your customers happy. And what I know is that that's because not that there's fundamentally a shortage of drivers, there is fundamentally an inability of the industry to adjust rapidly when the need for drivers goes up. And what I've done here is to graph the average number of drivers added per quarter. That's the red line, and it goes slowly up, and it's continuing to go up. And then I've graphed in blue what is required by industry conditions. So look back there at 04. You remember the tough times then if you're older. And what happened then is because of hours of service changes and a very strong economy, we needed to add more drivers than we do normally. So not on the red line, we needed to add a lot more. We needed to add, it turns out, 400,000 extra drivers in a relatively short time. And then, of course, in 09, it dropped off and came back in 14 and now went up high again. Well, the industry doesn't have the ability to accelerate that fast, and so we get behind. Now, since prices went up, the industry has been adding drivers, and I'll show you in a minute that we're now beginning to recover, and the capacity utilization is going back down again. But so the driver shortage is not fundamentally a shortage of people. It is the inability of the industry to rapidly adjust. Now, here's the conditions in 18 versus 19. And what I've done is to break down the change in drivers by whether it's growth or productivity. In 18, we had a lot of growth, and we had even more negative change in productivity, which required more drivers. That was the ELD mandate. People couldn't cheat as much as they had been. This year, growth has slowed down a little bit from last year, and productivity is flat. Because if anything, it's actually going up a little bit, and so the requirement for drivers may be going down. So rather than adding up the blue and the red to get somewhere around 4 or 5% extra drivers, we actually need fewer drivers this year. Right at the time when people are adding drivers like crazy because of last year. So if you wonder why spot prices are down, this is the evidence, and it's not likely to change the rest of the year. Let's go to the next slide. Let's see if I can get it to change. Sorry. Here we go. Let's see. Is it going to work? Sorry for the delay here. But the slides will not go. Let's see. Can we go? I'm trying to find a way to get the next slide. back up. Okay, here we go. Okay, yes. Now we're to the next slide, and you can see that capacity utilization, which is measured here, got up to over 100%, and it's falling down. So we would expect conditions in the industry to weaken. So let's go to the next slide and see if what it tells us. Okay. Oops, let me back up. I'm sorry. Okay. This is the latest truckstop.com data. It's actually 2 weeks old, but it's last week we didn't get any data from them. And what you can see, this is their MDI index, which is their measurement of tightness of the marketplace. High is tight, low is soft. And you can see it peaked in week 1 last year and has fell pretty steadily to the end of the summer and has stayed kind of in the same ballpark since, with a little bit further weakness. So, and I have graphed this against the recovery average. So 0 is normal. And what you can see, for instance, is flat's back to normal right now. The other guys are somewhat above normal, but nowhere near what they were a year ago. And those are the conditions I know you're all experiencing. And it is most likely that this number will slowly shrink the rest of the year. Not a lot, but enough to take off any remaining pressure on prices. Now, if we go to the next slide, let's see if it'll go. We'll see the pricing numbers. Here we go. And a month ago, they were almost back to normal. I've crossed that out because now the latest data says they are below normal for, you can see, reefers in gray, van is in orange, and flats just about back to normal. And this trend, this downward trend, is continuing to happen. Even though capacity may be leveling off a little bit, prices almost always undershoot. And that's what's happening right now. So my advice to you for the rest of the year is spot prices are going to be lower than they are now, somewhat lower. Not a lot, but somewhat. And if you want more precision than that, you can get on your knees and pray, because that's about as precise as we can get in this business. By the way, nobody else forecasts prices at all, so you're stuck with me. Let's see if we get the next slide. Okay, there it goes. If you're dealing with contracts, the numbers are a little bit better. The recovery is in green here. Yellow is 17, 18 is blue, and 19 is red, and you can see that they're staying high, but they're definitely past their peak. I expect these prices, because contract prices lag, and the way that we measure them lags, to stay relatively high for this year and begin falling next year. So if you've got contracts from the customer side, I expect those numbers to be fairly good this year. Relatively high. If you're dealing with the carriers on the spot side, prices will fall. If you're dealing with asset carriers, they should be about the same. Now, one other point, and that is that a lot of people say that spot rates are sometimes cheaper than contract rates, particularly right now. And if you measure the stuff that DAT and Truckstop puts out, that's in the dotted line here, and compare it to contract prices. They are low in contract prices, but what people have forgotten is that those numbers that the load boards put out are the numbers the carrier gets before the broker's cut. If you put the broker's cut back in there, which is the red line, the price that customers pay is higher, and it has to be, because the broker provides an essential service. So it's only at the bottom of the worst times, like in 15, that spot prices are lower than contract prices. The other thing about contract prices is that people prefer to deal with their contract people because the transaction cost is much lower. You negotiate a contract once a year, and that's it. Whereas spot prices, you got to do that work every time. So people prefer to use the contract market, usually because it's cheaper in the spot market, but it's always more convenient. It's only in the worst times that spot prices are lower. So I would not expect a lot of volume to be going from contract to spot right now. It's the other way round. In weaker times like this, with contract prices beginning to come down, I expect that market to keep its share, if not increase it. Now, what about 2020? And here is the data that causes me to be really worried about 2020. We are now in the longest recovery of all time, at least since 1946, when Donald and I were born. And this recovery is getting stale. How many more years of 16, 17 million auto sales do we need? And if you look at the construction numbers, and you look at the some of the manufacturing numbers and the durable goods numbers, they're beginning to falter. This is typical of late recovery times. So no one knows exactly when this recovery is going to end, but it is getting stale. And the staler it gets, the louder I'm going to shout at you to be ready for when it happens. Now, and so one of the things I'm doing is forecasting a slowdown, a late recovery slowdown in freight. That's shown on the left there. Goods output of the goods producing sector, which is what drives all of us, no longer is running up at 4 or 5%. I expect it to be 2 or 1%, which is typical of late recoveries because late recoveries are dominated by services. And the right-hand graph here shows that. You can see the blue is the intense truckload stuff, the manufacturing stuff. It was very strong early. Now it's weaker. Services are strong. So let's go to what my forecast is. And my base forecast for both years is, it's that wimp out economist forecast. A little bit less than today. So let's say a GDP of 2.3 this year and 1.8 next year, and freight 3 or 4% this year, and a little bit less next year. However, what I really focused on, what else could happen? And this year, the chances are still a little bit better that we could get a surprise on the upside, particularly in the second and third quarters, than a surprise on the downside. What I want you to remember about this presentation is next year those probabilities are worse. So you can be comfortable this year, but next year is the time when you have to worry about that chance of recession. So let's go on. See if I can get this to go. Here we go. Okay. Now, if we get recession, they're really important. A mild recession means a 4% drop in loads and because price falls too, a 7 or 8% drop in revenue. The Great Recession had 10 times more than, or 4 times more than that. So recessions are things that could threaten your business in very important ways. So my strong advice to you is, now's the time to begin thinking about what you'll do next year if this bad outcome occurs. Now, I'm going to take 5 more minutes and go through quickly because I'm almost done my time. Why this normal pattern that I've been describing for the last 20 minutes or so may change, almost certainly will change in the next 10 years. First off, just a couple things. We're no longer the dominant economy in the world. By some measurements, China's ahead of us already, and Europe is too. Other measures, they're not ahead of us, but certainly in terms of manufacturing, they are. So we're no longer the dominant power in the world, no matter what the President of the United States says. Second, this business about a deficit that we're running in Washington. If interest rates begin to rise, things get really hairy quick. The blue line here shows what happens if interest rates go back to normal levels, not the very low levels we had the last 10 years. This is what happens to what we have to pay our creditors in the United States. And it says by 2035, we'll be spending 40% of our tax revenue just to pay off the debt. Right now, it's about 8%. If our creditors take a look at the size of that deficit and say, wait a minute, these guys are not really trustworthy, we're going to charge them a premium. And by the way, the last time in 2010, they talked about downgrading our status. If that were to happen, we'd be paying almost all of our tax revenue just to cover the revenue on the debt service. So, things could change in ways that are really scary. Finally, or not finally, also, if we solve the deficit by taxing fuel like they do in Europe, we could get $2 worth of taxes on every truck mile. And when people talk about infrastructure spending, we don't have the current tax revenue to get it. And we're not going to go into debt for more infrastructure spending, I doubt very much. So it's very likely that taxes will go up in the short term just to cover whatever we finally agree on with infrastructure. And by the way, one of the ways we're going to do that is to put tolls on the highways. So the notion that taxes are only a small part of trucking could change pretty dramatically over the next 10 years. I'm going to skip this one. All this says is the change happens in buckets. And I'm going to skip this one also. All this says is that Walmart is changing its behavior dramatically given the threat from Amazon. We're already into a place where Walmart says it's cheaper to bring it to my house for free delivery than it is to put it on the shelf. That's what this slide says. Big changes. Now, here's one that you ought to think about a little harder, and that is in the retail sector, which is in the middle of the change already. Most of the stuff that will affect us is not there, but the retail sector is happening. This is the number of store closings by year, and the red is cumulative, that has occurred since the year 2013. We're now up to 30,000 stores have closed net. There are 30,000 fewer retail establishments now than there were in 2013. And that's because of this retail revolution. My wife and I now spend more money on Amazon than everybody but the local supermarket. Things are changing. And what this means to you is if you're in the retail side, your customer base is going to change. Who would have thought that Sears, who was the dominant retailer 30 years ago, would now be close to bankruptcy? Well, they went bankrupt, didn't they? Manufacturing is going to change pretty dramatically too. This is a additive 3D printer that you can lease time on at Office Depot, and we're just starting that one. So now here's another one to think hard about. Amazon promises next day delivery and sometimes same day delivery. And how do they do it? Well, right now, with the way trucks are, and I've added up the time it takes to get from a warehouse to the store, to your door, it takes 50 to 60 hours to get something. That's 2 or 3 days. It's pretty good, but that's what UPS does. In order to get that next morning or sometimes the same day, you have to have a whole bunch more warehouses. And that's what Amazon's done. They've got like 70 of them now. And they can get that delivery down to 1 or 2 days easily. Now, here's the point of this slide. If we go to automatic trucks, we can operate 24 hours a day. And if we have automated warehouses, which are already coming at us, we can get that same amount of time from 2 or 3 warehouses anywhere in the country. So there's radical changes happening in our supply chain that will be hitting us sometime in the next 10 years. Now, here is a couple of quick slides on the transportation impact. Left is what happens to capacity if you go to automated following distances. If everybody drives the same speed, which is what would occur if you have automatic cars, you get a 30% increase in capacity with no additional investment. If you get sophisticated following technology, where the cars are coordinated, you get a tripling of capacity. At the same time, by the way, those digital tools we're talking about will decrease the cost of fixing the highway. That's the red. So this infrastructure crisis that we're all worried about and we want to spend trillions of dollars on, 10 years from now will be gone. That's one of those great pieces of news. On the other side, what I've done here is to quantify very crudely what happens when you automate trucks to cost. And I'll just give you one example to show you how powerful it is. If you automate the driver, or if you put that driver in a remote location and allow them to work from an office rather than driving in the truck, you can keep that truck driving 24 hours a day. Right now, that truck is hauling loads about 8 hours a day. That's the max. Well, if you don't have to have a guy, that truck doesn't have to sleep with the driver or sit doing nothing while the driver eats, it can run what, 21, 22 hours a day? Doubling or tripling its productivity. What that means is that the cost of trucking is going to go way down. Now, this is not an all or nothing change. We're not going to wait until we get complete automation. By the way, automation will come when we automate the cars. That's the driver here. You and I are very, very lousy drivers by nature. We talk on our cell phones. We look at the pretty pictures. We wonder about what the guy next to us is going to do. We are sipping on our Coca-Cola. We're not driving. Well, sometime in the next 15 years, people are going to figure out that we can prevent those 35,000 deaths a year by automating the cars and forcing the rest of us to automate. When that happens, the trucks get automated too. In the meantime, there's lots of things we can do, and what I've done is simply to do my research and to talk about how we are going towards full automation steadily. So even in 2025, the driver's job will be practically trivial. Right now, they control with speed, they can control with stopping. By that time, they control almost everything. So we don't have to wait till 2035 to get many of these benefits. I would expect sometime in the mid-20s that prices will begin to show it. By 2030, the price for a truck, taxes not included, will be quite a bit lower. Now, all I'm saying here is that if you look at all of these things, by the year 2040, they'll all be with us, and most of you will still be working. So your careers are going to be dominated by this. So what to do about all this? Well, in the short term, focus on that. Focus your activity. You're on the old cycle, and worry about whether or not we're going to go down into recession next year, or we're going to slow a little bit this year. What it says about the future is now's the time to start studying. It's too early to be investing in a lot of this stuff unless you're in a warehouse. If you're a warehouse, you better be automating because it's happening already. Or if you're dealing with a retail side, your customers are changing. But at the very least, you ought to be spending quite a bit of your time learning about this stuff. So when we know what actually will happen in 2025 or 2030, you will have already been up the learning curve and can be the first one to adapt to them rather than the last. So, Mark and Erica, that's the end of my formal remarks. Let's go to questions.
Well, thank you, Noel. We're now going to open up the Q&A portion here. Actually have a question that was sent in from Chuck in York, PA. Chuck asks, what do smart shippers do in recessions?
Smart shippers do in recessions. Well, the stock answer is they rebid their business. I don't think that's a smart thing. The smart thing to do is to use the power that they have at the bottom of recession in terms of load availability to cement relationships with their best core carriers. give those guys or gals the steady freight that allow them to survive so that when we come out of it, they'll be healthy and they'll have the capacity to help you when you need them. So right now, what you want to do if you're a shipper is you want to go short on your contracts because prices are going to fall. You want to be looking for those, you want to be grading your carriers and figuring out which ones are the best. So they're the ones that you're going to favor. And the other thing you should be doing is watching your budget because your bosses are going to be cutting your budget in the next couple of years because your company will be in recession. People think that times are good for shippers in recessions, but of course the shipper's business is suffering. So in summary, Chuck, I would say at the bottom of recession, you want to be looking for you ought to be favoring your best carriers. Oh, and one other thing. At the bottom of the recession is when you want to go long on your contracts because prices are going to be going up soon when you're at the bottom. Now you want to be short, then you want to be long. Other questions, Mark?
Yeah, something to actually play off of Chuck's question. We have Nancy in Hoboken asking what she can do to build stronger relationships.
Okay, well, I guess there's two fundamentals here, three. The first one is you definitely want to be working on digital integration with your best partners, whether they be shippers, customers, or anybody, or shippers or carriers, because the future is going to be largely taken through those tools. The telephone is going the way of some of the other things that we've lost over the last 50 years. So the first thing is invest in technology. The second thing is, at least for the next 5 years, treating the drivers right is a great investment. Drivers know who the good shippers are and who the bad shippers are. They know where the good bathrooms are. They know who gets them in and out of the dock quickly, and they go there. They'll take those loads much quicker than they would otherwise. So that's the second thing. And the other thing is, and this is the hard part that nobody has really gotten right yet, and that is you want to figure out how to manage through the cycle. Historically, what shippers would do would be to knock the carriers over the head at the bottom of the cycle and then plead for capacity at the top. And the carriers exactly the opposite. Well, that kind of volatility is not good for business. You're far better off to have good relationships that work in both ways. And so what that says is, in the bottom, if you're a shipper, you want to be granting favors to your best carriers, and the ones whom you trust, because they're the ones who will grant you favors at the top. And if you know you can get capacity at the top, you're way better off than having to not having rebid your business all the time at the bottom. And the same thing goes for carriers. So it has a lot to do with relationships, and it has to do with communication. Next question.
You mentioned how important it is to invest in technology. Considering your suggestion to take a conservative approach in 2019, it would now still continue to be a good time to invest in technology?
Well, that's a very deep question, Mark, and I have two answers. The first answer is you have to put the various tools in different buckets. Some of the stuff is already happening. Some of it's down the road a little bit. The best thing to be doing is to be experimenting right now. Take a few things where you can where the technology is relatively well developed and start getting used to it, so that when the obvious solutions come out, you you already have experience and you can adopt them pretty quickly. One really strong piece of it of advice is the more of this you can outsource, the better off you are. People like to keep technology in-house. They have a brother-in-law or somebody who's really good at it, or they want it to be tailored exactly to their own specifications. The problem is that gets very expensive, and technology moves so rapidly that you want to delegate that work to the experts. For instance, my partners at truckstop.com are among those experts, and they're developing a digital freight matching solution. And they're putting millions and millions of bucks into that solution, the kind of thing that a broker or a shipper or a carrier could never do. So what you want to be doing right now is starting to make your plan and experimenting. And if things are obvious, get on the bandwagon and use them. I am not a tech guy. I can't tell you whose software is best. But now's the time to begin adopting the entry-level stuff and to experiment with the more complicated things. Next question.
We have a question from Justin Huffman. Has anyone quantified what the savings of a truly autonomous truck would be versus a driver-run truck?
Sure. I've taken a cut at it, Justin, and very crudely, I think it's half. Other people think it's 2/3 savings because the truck can now run 3 times as long as it could. What's unknown about this is if we drop the price of the truck that much, are people going to begin using them differently? And I'll give you one scenario just to show you how radical the future is going to look at. If we look at the retail sector and we agree that everything's going to be ordered over the internet and a whole bunch of that stuff's going to be delivered to my door, you don't want big 53-foot loads. You want little loads, so they don't have to be rehandled when it gets to my neighborhood. So if I'm shipping something from a Amazon warehouse in Pittsburgh to Lebanon, where I live, I don't want to have to ship it to Harrisburg and have it rehandled, so it goes out on a small truck to Lebanon. If the truck, in essence, if the truck cost is a fraction of what it is today, maybe I won't put it in a 53-footer and run it down a turnpike. Maybe I'll put it in a panel van, and there'll be 5 panel vans rather than one truck. But each panel van will go directly to a neighborhood with no additional handling. So we're talking about some pretty radical changes. And what I mean by that example is we may take a bunch of the savings and turn it into service rather than cost reduction. So it's possible, theoretically possible, that the price of the truck will not change at all over the next 30 years, just that the service will be 10 times better. It'll be somewhere in between that. Next question.
In the interest of time, we'll ask one more question here, Noel, from Rob Peterson, and this is regarding the Amazon Freight Brokerage Division. What's your opinion on the impact to the industry that'll have?
Another good question. Here are the facts. There are 2 of them. No, there are 3 facts. Fact number 1 is Amazon has the scale to be a very large player in the brokerage and freight management industry. right now, their North American freight spend is still behind UPS and FedEx, but it's damn close. The amount of freight they control. So if we think that FedEx and UPS can be long-term survivors, then certainly Amazon could be. They have the scale to do it. The second thing is they have the interest in doing it. They are a very, very strongly, I want to do my own thing company. So it's almost certain that they will attempt to not only do all their own management, but will attempt to manage other people's freight as well. You know, 2/3 of the stuff that they sell is owned by somebody else. However, it all runs through their ordering system, and quite a bit of it runs already through their supply chain system, even though it's not theirs. So yes, they are very big, and they intend to get bigger. The only question is whether they will have the focus and the skill to compete against people who do this for a living. Amazon has a lot of different businesses, and they're relatively new to freight brokerage and to managing freight. And they're bound to make some mistakes. And so the question is, you know, when they get bloodied a little bit in the marketplace, will they step back and say, wait a minute, we're going to get some partners who can help us, who have this expertise? I think the jury's out on that one. So we know for sure in the future, in the near future, that they are going to be there and aggressively competing. Whether they'll still be trying to expand 10 years from now is an open question, because markets are very competitive. Thanks, Mark.
Well, we certainly want to respect everyone's time, so we're going to bring today's webinar to a conclusion. If there are any further questions or comments, our contact info is listed on the slides, so please feel free to reach out to myself or Noel directly. Recording of this webinar is also available upon request if anyone would like to review or share with your colleagues or coworkers, anyone who couldn't attend. But I'd like to thank Noel for a great presentation, and we also appreciate everyone's participation today. We hope you were able to benefit from the webinar, and please consider completing our brief feedback survey that will be sent to your emails after the webinar. Thanks very much, everyone, for your time. Hope you all have a great day. Appreciate it.
Be safe, everyone.
Thanks, Noel.
Bye-bye. Bye-bye.